All right, let's talk about RSUs, restricted stock units. If you've ever gotten these as part of your pay, you know that feeling, right? It's exciting, but it's also, well, it's super confusing. What are you supposed to do with them? Sell one right away? Hold on and hope for the best? What about taxes? Don't worry, we're going to unpack all of that today. And look, if you're confused, you're definitely not alone. I mean, check out this question from a Reddit user. It just hits the nail on the head, doesn't it? It captures that exact dilemma that so many of us face. There's a ton of conflicting advice out there, and yeah, the stakes can feel really high. But we're gonna get you through it. Let's start from square one. Okay, so first things first. Before we can make any smart decisions, we have to get really clear on what an RSU actually is. And honestly, this is the most important mindset shift you can make. Stop thinking of your RSUs as some kind of free stock or a lottery ticket. Start thinking of them as what they really are: compensation. Right. So at the beginning, an RSU isn't actually stock. Not yet, anyway. It's basically a promise. It's your employer saying, hey, if you stick with us for a bit, or we hit these company goals, then we'll give you these shares. The key things to remember here are promise and conditions. You don't actually own anything right at the start. You can think of every RSU having a little life cycle. It all begins on the grant date. That's the day the company makes you the promise. Then comes the vesting period, which is just the waiting game. You're waiting for time to pass or those milestones to be met. And then the big day, the vesting date. That's when the promise is kept, and boom, those shares are officially yours. Okay, now here's the most important part of this whole thing. So listen up. When your RSUs vest, their total dollar value is taxed as ordinary income. That's right. The IRS looks at that pile of stock and sees it the exact same way it sees your paycheck or a cash bonus. It's not some special investment windfall, not yet. It's just income. Grasping this one concept, I'm telling you, it changes the entire game. So let's walk through the tax journey here. On the day you're granted the RSUs, nothing happens. No tax. But the second they vest, bam, you're hit with ordinary income tax on the entire market value of those shares. Now, here's a cool part. If you sell them immediately, there's no extra capital gains tax. Why? Because there was no time for the stock to gain any value. But if you decide to hold on and that stock price climbs, any money you make above that initial vesting value will get hit with capital gains tax when you finally do sell. So now that we get the taxes, it brings us to the really big question, right? What's the risk of just holding on to all that stock? I mean, it's one thing to be wealthy on paper, but the real challenge is making sure you actually preserve that wealth. And the number one risk, by far, is creating what finance folks call a concentrated position. It's the classic all your eggs in one basket problem, but on steroids. Just think about it for a second. Your paycheck comes from this company, your bonus, probably, and now a huge chunk of your net worth is tied up in its stock. Your entire financial life is riding on the performance of this one single company. That is a huge bet to make. And when we talk about risk, the math for getting back to even after a loss is, well, it's pretty brutal. It's not a one-to-one thing. Let's say your stock drops 20%. You might think you just needed to go up 20% to be whole again, right? Nope. You actually need a 25% gain just to break even. And look at this chart. The further it falls, the crazier the climb back up gets. Yeah, but you might be thinking, my company is different, we're going to crush it. And maybe you will. But let's look at a pretty sobering number. Between 1980 and 2020, a full 42% of all the stocks in the broad Russell 3000 index actually had a negative return. That's almost half of them literally lost money for investors over the long haul. It just goes to show, holding a single stock is always a gamble, no matter how much you love your company. Okay, so we've talked a lot about the why it's risky. Now let's get to the what. What can you actually do about it? The good news is you've got options. There's no single right answer for everyone, but there is a whole spectrum of smart strategies you can pick from. All right, strategy number one. The simplest, cleanest option is to sell everything immediately the second it vests. The advantages here are massive. You instantly wipe out that single stock risk. You've got the cash on hand to pay the taxes, no problem. And you've freed up all that money to diversify, pay down debt, whatever your goals are. The only real downside, that nagging feeling of what if, that fear of missing out if the stock suddenly shoots to the moon after you've sold. Okay, if selling everything feels a little too extreme, you could try a more balanced approach. Think of it as an 80-20 rule. You sell the majority, like 80%, to cover your taxes and seriously diversify, but you hang on to that other 20%. This way, you're protecting yourself from most of the risk, but you still get to keep some skin in the game for that potential upside. It's a really solid middle ground strategy. Just be careful that over time, that 20% from each grant doesn't eventually become a concentrated position again. Strategy number 3 is what a lot of people do by default because it's just so easy. Your brokerage probably has a button that says sell to cover taxes. You click it and it sells just enough shares to handle the estimated tax bill. Simple, right? But here's the catch. It's also the highest risk option because you're left holding the maximum amount of company stock. And a big warning here, the amount they withhold for taxes, which is often a flat 22%, might not be nearly enough to cover what you actually owe. That can lead to a really nasty surprise when you file your taxes. So you've got these different strategies. How in the world do you choose? Well, it all boils down to one simple but really powerful mental trick, a framework you can use every single time a new batch of your RSUs vests. And this is it. If you take away only one thing from this whole explainer, let it be this. Your RSUs are not a gift. They are not a lottery ticket. They are compensation. It's income you earned, plain and simple. It just happened to be delivered to you in the form of stock instead of cash. And that leads us to the final clarifying question you should ask yourself every single time. Imagine this. Instead of stock, your company just handed you a big cash bonus for the exact same amount. Would you take that cash, log into your brokerage account, and use every last penny of it to buy your company's stock? If your answer isn't an immediate, enthusiastic heck yes, well, then you probably have your answer.